Hello, and welcome to our video on creating a budget to manage student loan payoff. If you are a student or recent graduate with student loan debt, you may feel overwhelmed by the process of trying to pay off those loans. However, don't worry. There are steps you can take to make this process easier and get back on track to financial stability. First, let's discuss the two main types of student loans: federal student loans and private student loans. Federal student loans. When it comes to student loans, there are three main types of federal loans to consider: direct subsidized loans, direct unsubsidized loans, and direct plus loans. Direct subsidized loans are available to undergraduate students with financial need, and the government pays the interest on these loans while the student is in school and during deferment periods. Direct unsubsidized loans are available to undergraduate, graduate, and professional students, and the student is responsible for paying the interest on these loans, even while in school. Finally, direct plus loans are available to graduate or professional students and parents of dependent undergraduate students, and the student or parent borrower is responsible for paying the interest on these loans. It's important to understand the terms of these loans and the interest rates associated with them, so you can make informed decisions about repayment and choose the option that's best for your financial situation. Private student loans. Private student loans are offered by banks, credit unions, and other private lenders. These loans are not backed by the government and typically have higher interest rates than federal student loans. Private student loans also typically have fewer repayment options and may not offer the same protections, such as loan forgiveness programs, as federal student loans. So, how can you pay off those student loans? First and foremost, it is essential to create a budget. A budget is a financial plan that helps you track your income and expenses, so you know exactly where your money is going. By creating a budget and following it consistently, you can take control of your finances and work towards paying off your student loans. One effective budgeting method is the 50-30-20 rule, where you divide your after-tax income into three categories: 50% for necessities, 30% for wants, and 20% for savings and debt repayment. This can help you make sure you are covering your basic needs and putting some money towards your debt, while still allowing for some room for fun and enjoyment. To help pay off your debt more quickly, it is also important to cut unnecessary expenses. One way to do this is by looking for areas where you can trim your spending, such as subscription services you are not using, or by reducing your dining out or takeout expenses. Another way is to pick up a side hustle, which can be anything from freelance work to a part-time job. This is a great way to bring in extra money and put it towards your debt, while also building valuable skills and experience. Additionally, you may want to consider negotiating for a raise at your current job. It's worth asking for a raise, as it can help you increase your income and pay off your debt more quickly. To do this, it is essential to have a clear idea of your worth and be able to back it up with your accomplishments and the value you bring to the company. If you're enjoying the content so far, make sure to hit that subscribe button to stay up to date on all our future videos. By subscribing, you'll be supporting our channel and helping us create even more great content. Now back to our topic. Now that we've covered the basics of creating a budget to manage student loan payoff, let's delve a little deeper into some specific strategies you can use. Building good credit. Building good credit is important because it can help you to obtain loans and other forms of credit at more favorable terms. One way to build good credit is by making timely payments on your debts, including student loans. If you consistently make your student loan payments on time, this positive payment history will be reflected in your credit report and can help to improve your credit score. On the other hand, if you miss payments or default on your student loans, this negative payment history will also be reflected in your credit report and can hurt your credit score. By building good credit and making timely payments on your debts, including student loans, You can help to improve your credit score and set yourself up for financial success in the future. Tips on how to prioritize debt repayment and pay off student loans more efficiently. First, consider consolidating your loans. If you have multiple student loans with different interest rates, consolidation can be a helpful option. By consolidating your loans, you can combine all of your debt into one monthly payment, which can make it easier to keep track of and potentially save you money on interest. However, keep in mind that consolidation may not be right for everyone, and it's important to carefully consider all of your options before making a decision. Here are a few important tips. Focus on paying off high-interest loans first. If you have multiple loans with different interest rates, it may make sense to focus on paying off the loans with the highest interest rates first. This can save you money on interest in the long run and help you pay off your debt more quickly. Use the snowball method. The snowball method involves paying off smaller debts before larger ones, regardless of the interest rate. This can be a helpful strategy for students who need the motivation of seeing progress and want to pay off their debts as quickly as possible. Consider refinancing. If you have high-interest student loans, refinancing may be a good option to consider. Refinancing involves taking out a new loan to pay off your existing student loans. The idea is to secure a lower interest rate, which can save you money on interest and potentially make your monthly payments more manageable. However, it's important to carefully consider all of your options before deciding to refinance, as it can be a complex process. Make extra payments whenever possible. If you have extra money available, consider making additional payments towards your student loans. This can help you pay off your debt more quickly and save you money on interest. Consider an income-driven repayment plan. If you have a low income or are struggling to make your monthly student loan payments, an income-driven repayment plan may be a good option to consider. These plans, which are offered by the federal government, tie your monthly student loan payments to your income. However, it's important to keep in mind that enrolling in an income-driven repayment plan can result in you paying more interest over the long term. So it's important to weigh the pros and cons before deciding. Finally, don't forget about student loan forgiveness programs. These programs, which are offered by the federal government and some private lenders, can forgive all or a portion of your student loan debt if you meet certain requirements, such as working in a public service job or teaching in a low-income area. It's worth looking into these options to see if you might be eligible. In addition to these strategies, there are other things you can do to help manage your student loan debt. For example, make sure to pay your loans on time to avoid late fees and damage your credit score. It can also be helpful to set goals for yourself, such as paying off a certain amount of debt each month or making extra payments whenever you can. Defaulting on your student loans can have serious consequences that can impact your financial stability and future. Here are a few potential consequences of defaulting on your student loans. Wage garnishment. If you default on your student loans, the lender may be able to garnish your wages to collect the debt. This means that a portion of your paycheck will be withheld and used to pay off your student loans. Damage to your credit score. Defaulting on your student loans can also have a negative impact on your credit score. Your credit score is a measure of your credit worthiness and is used by lenders to determine your eligibility for loans and credit cards. A low credit score can make it more difficult to secure financing for things like a home or a car, and may result in higher interest rates on loans and credit cards. Legal action. In some cases, the lender may take legal action to collect the debt, such as suing you or obtaining a judgment against you. We don't want that. This can result in additional fees and cost, as well as damage to your credit score. Difficulty securing future loans. Defaulting on your student loans can make it more difficult to secure future loans, as lenders may view you as a high-risk borrower. This can impact your ability to finance things like a home or a car and may result in higher interest rates on loans and credit cards. Managing student loan debt is a process and may take some time. But by creating a budget and using the strategies outlined in this video, don't forget to subscribe. You can take control of your finances and work towards paying off your debt. Don't be afraid to ask for help or seek out resources if you need them. With a little planning and discipline, you can get back on track to financial stability. Thank you for watching, and we hope this video has provided you with the tools and information you need to create a budget and manage your student loan repayment. Remember, taking control of your finances and paying off your student loans can be a challenging process, but it's worth it in the long run. If you have any additional questions or need additional resources, don't hesitate to reach out for help. We are here to support you on your financial journey and help you achieve your goals. Thank you again for watching, and we wish you the best of luck in your debt repayment endeavors.